Hello, my name is Michael Hooper, and today I'm going to talk about how I make money in the stock market. I got involved in the stock market in 1993 after I got married. I wanted to be a good steward with our money, and so I talked to a local stockbroker in Grand Island, Nebraska named Charles Armstrong. And I asked him, how do I get involved in the stock market? And he said, read everything you can get your hands on about money. So I read everything I could. I read about the Wall Street Journal, um, Money Magazine, Kiplinger, and my favorite is Value Line because Value Line was able to put everything you needed to know about a stock on one page. I also asked him, how much do I need to get started? And he said about $1,000. I ended up opening a couple of accounts with Charles Schwab and started buying stocks. My first stock was Motorola, and then I went on to buy many more stocks after that. Another mentor of mine was a man by the name of Pete Valonis. Pete was the owner of the Candy Cafe in Grand Island, Nebraska. He was also a very shrewd investor. He said buy stocks in companies that generate tremendous amount of daily cash flow, have minimal debt, and don't get in trouble with the government. His top pick was Wrigley gum. I looked into this stock and found that it had tremendously good cash flow, minimal debt, and good products and good profit margins, and was generating about a 15% annual return. So I thought, this is a pretty good deal. I've got to get in on this. So I started buying Wrigley, and here's one of my first trades in that stock. I bought 36 shares at $44 per share. Total cost was $1,639 in 1995, and the commission was $55. I remember making trades like this in the 1990s. I had to call them in to Schwab and get the trade done over the phone. Back then, with trading costs so expensive, it did not make sense to trade stocks. You buy and sell, well, you might lose all your profit in commissions. So it really was best to be a buy and hold long-term investor. And to this day, I'm still a buy and hold guy, although sometimes I do some short-term trades, but they're very rare. Another mentor at the time was, it still is Warren Buffett. I was living in Nebraska, and he was a bit of a hero to Nebraskans. His Class A shares at that time were around $55,000 a share. There were many people I met who had a chance to buy that stock when it was much cheaper, say around $500 a share, and they regretted not doing it. I didn't want to be one of those people. So when Warren Buffett announced that he was going to issue Class B shares at much more affordable rates, I decided I got to get in on this. So I drained all of our savings accounts and checking accounts and brought them down to like $10 a piece and told my wife, don't buy anything for a week here. We are putting our money in Berkshire Hathaway. I came up with $4,400 to buy 4 shares, and here's the original trade in 1996, and I bought 4 shares at $1,110 a piece. I remember the stock actually fell down right after I purchased them, but I hung on. Those 4 shares ended up, there was a split 1 for 50, and those 4 shares became 200 shares, and today they're worth about $280 a piece, or $56,000, those original shares that I purchased. So thank you, Warren Buffett. Warren Buffett also provided just a tremendous example of how to be a good investor. I read the book The Making of an American Capitalist by Roger Lowenstein, a fantastic book. There's other books about him, but this one really captured his general style of investing. And I would also recommend reading his annual reports and specifically his annual letter for advice on how to invest. But one of the main things I remember from him is just investing in what you know. If you don't understand the business, you can't grasp how they're making money, then you probably should just throw it out. I definitely can understand candy companies. Wrigley was a great deal. Another one I liked was Hershey. I own that today. My wife and I ended up buying quite a few shares of Wrigley over the years, and we ended up with about 380 shares. And when the company Wrigley was sold to Mars in 2008, we received about $28,000 in proceeds from the sale. And I redeployed the proceeds, all that cash, into other stocks during this financial crisis of 2008 and 2009. I was buying utilities, consumer defensive stocks like PepsiCo, Johnson & Johnson, and the railroads. Really, and I think that money that I invested back then probably has tripled or quadrupled since then. I also want to talk about buying in the indexes, specifically the S&P 500. I think every portfolio should own some S&P 500. I think, the S&P 500 has done 14% annual returns for probably since inception. And so that's a really excellent return. Most money managers cannot beat the index, so you might as well own the index. This is sort of a Buffett-ism as well. And a good way to get into the indexes is by ETFs like SPY. Another one is IVV. Those are ETFs that track the S&P 500. I own both of them. They are very liquid. You can get in and out of them quickly, but I would recommend that you hold them and never sell. Another thing I want to talk about is the railroads. I got involved in the railroads following Warren Buffett in 2009, 2010, and 11. I had covered railroads as a reporter and editor and knew about their dominance in the transportation industry. They can ebb and flow with the economy, so they can make money even when the economy is not doing that well. They're very economically sensitive, and they have great profit margins. The Union Pacific profit margin is about 26%. So after I left the newspaper industry, I started buying them quite a bit, and that turned out to be very lucrative and very profitable. I own Union Pacific, CSX, Canadian National Railway, and Norfolk Southern. I also want to talk about trading. You see a lot of videos on the internet about day trading and scalping and swing trading. These videos are garbage. Stay away from them. Most people who trade day trade, do not make money. I know people who try and have lost substantial amount of money. So stay away. Stop trading. Be an investor. Another story I want to talk about is buying low beta stocks. Low beta stocks. Well, beta is a measure of volatility, and a beta of 1 is essentially the market. So the S&P 500 would have a beta of 1. A low beta stock around a 0.75 beta or a 0.5 beta is lower volatility. And if it's a really, really good stock, it will probably grow modestly over time. And one of those stocks is Church & Dwight. CHD is the ticker. This company has a really good product mix, includes Trojan condoms, water pick, vitamins, and Arm & Hammer baking soda, cleaning products, and so forth. Things you need on a daily basis. I like those kinds of stocks. Another thing I want to talk about is the whole idea of commission-free trading. This allows you to buy even just one stock at a time without commission. So, and a good way to use this, commission-free trading to your advantage is to buy, especially volatile stocks in fifths, meaning that if you're trying to buy 100 shares, buy 20 at a time. So let's say, for example, you have a stock that you buy at $50 a share. Well, you buy 20 shares at 50, and then it drops to 45. Well, if it's a very good company and has good metrics and good cash flow and is trading at a low PE ratio relative to its peers, well, maybe buy more stock. Buy 20 more shares at 45. And let's say if it goes to 46 or 47, you buy 20 more. And it goes to 48, 49, you buy 20 more. It gets to 51, you finish out your trade, you get your other 20 shares, and now you have 100 shares, and and then hold it. So this is kind of also a way to approach it is dollar cost averaging, meaning that you buy a little every month, and over time this kind of evens out your cost basis. And so that's a really good trick. I also want to share a story of a mistake I made, and this will have some lessons for you. I certainly learned a lot from this. Back in 2001, after the tech crash, I asked an investor by the name of Bruce Newberg, what are you looking at? What are you investing in? And he said he was looking at broken technology at the time. And one of the stocks that he liked was Apple. Steve Jobs had just come back to the company, and it was trading at $14 a share and had $12 per share in cash. So he was like, well, how low can it go? Even if they liquidate the company, you'd only lose $2 a share. So with this kind of margin of safety, it looked pretty attractive. So I bought 200 shares at $14 per share, and it quickly ran to 18. I sold and made $800. I thought $800, that's pretty good. Well, guess what? That stock went up to gigantic levels, and had I kept it, those 200 shares would have split multiple times, and I would have several hundreds of thousands of dollars more. So lesson learned, if you have a really good company and it's doing really well, hold on, don't sell. You probably will be richly rewarded for holding on. Okay, well, that ends my talk. I wish you well in your investing, and thank you for taking the time. Goodbye.